Hi, Andrew here. I wanted to take a few moments to explain my investment philosophy and how I invest client money. And a major part of that is something called factor investing. So the purpose of this video is to explain a bit more about what factor investing is all about. But in summary, it's about identifying the sources of investment returns through academic research. And what the academics have done over the past multiple decades, actually going back as far as the 1930s, is sliced and diced the global stock markets and looked at the investment returns and tried to identify if there are any commonalities, any shared characteristics of company shares that have driven stock market returns. Over any period of time, if you look at stock market returns, there'll always be some winners and some losers. It's not that every share contributes the same amount of return to a stock market in a weekly, monthly, yearly, decade basis. So the academics have looked for this common ground to say, well, if we can separate particular factors, particular characteristics and invest in these, are we likely to get a premium over the main stock market returns if we invest long enough? So it's been the evolution of these findings over the multiple decades. And in some cases, such as the robustness and depth and quality of the research that has led to Nobel prizes for the academics who've studied it and uncovered these factors. So there's been 6 main factors that have been identified that if you invest in them over the long term, you should get a premium over the market. The first one actually is the market itself. So if you invest in stock markets over the long term, you should expect a higher return compared to any other asset class, be that cash, government bonds, corporate bonds, commodities, property. So the first factor discovered was this, that the market provides superior returns. You need to be rewarded for the risk you accept when investing in stock markets. The second one within stock markets was about relative price, and that's saying company shares that are low in price relative to the value of assets tend to outperform companies where the share price is high relative to the value of the assets. So it's unloved, unwanted shares that tend to do better over the long term. The third factor is that of size, and it identified that small cap stocks, small company shares, tend to outperform large company shares, again over the long term. Another factor was that of momentum. So a share that has got a positive price momentum or even a negative price momentum is going up or down in value, tends to continue that trend for a short period of time. So you can ride that wave and capture those returns for a short period of time. Another factor was that of quality. So companies that are highly profitable, have low debt, have positive cash flows, tend to outperform those who share the opposite characteristics, are highly leveraged, unprofitable, have poor cash flows. And the final one was that of minimum volatility. So share prices that move very little, have a very little range of fluctuation, tend to provide better risk-adjusted returns, so they offer less risk than shares where the variation of returns is much higher. So there is no one best factor. It's not saying, well, if we invest in value, we'll know that we'll beat the market each and every year. And it's also no secret sauce. These factors are cyclical. So value had a very poor decade actually, if not longer, from the credit crunch actually really up to last year, where growth outperformed it. But if we look over the longer term, we know that value should provide a premium over the market and over growth companies. And the important thing also is they're uncorrelated. So for example, if momentum shares are doing particularly well, value ones will do poorly, and vice versa. So by combining them all within a portfolio, we can get a better risk-adjusted returns. In other words, we can get superior returns in the market as a whole, but not take any additional risk. And as I've said, there will be periods of times when a particular factor underperforms. And if you're investing just for a short period of time, the probability of outperformance is actually relatively low. But the longer you invest for, the probability of benefiting from the premium of these factors over and above the market increases significantly. So much so that if you're investing for 10, 20 years, the probability of outperformance of a factor is around the 90%, if not mid to high 90s for some of them. So as with any investment, it's about investing with patience and discipline. But everyone, even if you're in retirement, can probably look at a period of investment time of 10 plus years. So you can benefit from investing in these factors and hope to and expect to get positive returns over and above the market. So that's everything I wanted to cover in this video. In the next video, I'm going to explain a bit more in detail about what these factors are and why they exist. So please do look out for that one. Hi, Andrew here.